All right. Welcome in, everybody. Trader nerds, welcome. Real traders never trade alone. They trade with their fellow nerds like Brad and Carlos and DB and Donnie and Dwayne and iPhone and Edwin. And who else we got here? We got Edwin, we got Jason, we got Jim, we got John, we got Kevin, we got Lance, we got Matt Jollywally, we got Matt, Mike, we got Mo, we got Nadia, Notional Ed, Pansy, Reginald, Ricardo, Rodney, we got Schwaz, Scott, Stefan, Steven, Thomas, and Vicky and Walt. So I got a great group in here, and we're very excited because most of us are trading, and I have now moved all of my accounts over to Tasty Trade, and we are honored to have Mr. Tom Preston with us. We call him TP. And hey, Tom, how you doing today?
Well, I'm good, baby. Okay, is my video coming through and audio?
Yeah, you look good.
Excellent, thank you. And by the way, through all those names, you forget the most important person, Sweet Bobby.
Sweet Bobby, that is
Yeah.
right. Yes, I tell you, Tom, we know you as the real brains behind the Tasty operations, and it's an honor to have you with us here today for sure.
Well, thank you very much, and I appreciate everybody taking their time out to join us today. I know it's summertime, there are other things to do. If you want to take a break from trading and all, but all I do is I sit in air-conditioned comfort all day and press buttons. That's what I do, and I'm grateful to be doing this and not having to work outside. That's all I can say.
Yeah.
But like Bobby said, I built a lot of the trading functionality back in the old Thinkorswim days. If anybody's from over there that is now part of Schwab, as well as Tasty Trade way back when. And I trade every single day, and all my stuff. And I heard Bobby mention that his accounts are now with Tasty Trade. Thank you very much, Bobby. Appreciate that. And so I don't want to make this an advertisement for the brokerage firm. That's something that everybody can decide for themselves. But Bobby, you had, I guess there are some questions about functionality and how to get some answers from the platform. So do you want to kind of lead that off?
Yeah, TP, here's kind of what we noticed, and I think that we've got it figured out, but we really wanted to get your take on it just to make sure that that we're doing things correctly. What most of us trade here, Tom, we do something that's called a 1-1-1 or a 1-1-2 trade. We sell a naked put, and we also put a little bit of a hedge on by doing a put debit spread. And generally we do that on ES, or we do it on the micros. And so our Achilles heel with our strategy, of course, is the Black Swan event. So we noticed that the analysis tools that you guys put together for Tasty, it seems to be a little bit different than what we're accustomed to on Thinkorswim. And that's why we just wanted to make sure that we're understanding it correctly. So what we do is we've been doing this, and we also put on a trade that's we call the Sweet Bobby hedge, or the Black Swan hedge, which is nothing but a put back ratio spread that we do in the E-minis as a little bit of protection to the downside. So let me just show you
those are great trade ideas. I love those types of strategies. And what I really like about them, Bobby, too, is they're flexible in that each one of us could adjust the strikes or expirations or whatever we want to do to tailor our risk profile. So anyway, but go ahead. I didn't want to cut you off there.
So the one thing that we like, and I'll show you the first thing that we really like, is this little P&L graph here that kind of shows us, how we're doing with our trades. And we make a limited amount of profit if the market goes up. We make an oversized profit if the market slowly goes down. And of course, we have risk down here to the downside. So we just wanted to kind of cover that. So here's what we've been doing, TP, and just make sure that I'm doing it right. And if you see anything different that I need to do, then let me know. But we hit this little button called Cap Requirement over here on the right. And then we park our unused cash into a treasury bill ETF called bill. So we really don't analyze it, but we go and we analyze all of our ES and micro positions. So we check those. And then we
Yep.
go to this little risk analysis tab.
Yep.
And then we get an opportunity. I'll just show you how I set it up and then tell me if we're doing something wrong or incorrectly. On this IV shift, I normally go and change this to points. And I'm moving this thing up normally to 25 or more to try to figure out what a 20% down looks like in my account. And then we get this number, which kind of says, hey, if we were to have a 20% down move and the IV goes up 25 points. So, and I guess since we trade, here's my assumption, TB, knock me out of the water on this or not. So if VIX now is, and I hadn't looked at VIX today, but let's say it's 17, an IV point shift up 25 would mean that this would probably approximate VIX at a 42. Am I?
Yes.
Okay.
Yeah, that's because what you're doing, Bobby, is using points.
Yes.
So in other words, and this is one of the confusing things about volatility, it is a percentage. In other words, VIX is today, pull it up real quick. Yeah, like you said, 17. That is 17%. But to a trader, I'm thinking it's 17. If it goes from 17 to 18, it went up a point. Okay, that's how I will talk about it because I see it as its own underlying. But theoretically, in the calculations, it's a percentage. But what you did when you switch that over 2 points, Bobby, is instead of going, let's say, 20%, which would be about what, $3.40 or 3 point. In other words, 17 times 1.2. What you did was you said, okay, it's 17 plus 25. That's what the points do. Nothing wrong with that. Nothing wrong with that. So here's what I would, and I was thinking about, some of the information that you guys might be curious about or have questions about. Where does that 25% number come from? And I'm not putting you on the spot, Bobby, and I'm not, you're not doing anything wrong. That's not my point. But there are a couple of things that you can do to maybe make it a little bit more quantifiable.
Okay.
What I would do, and you can go into anything. And so if you go into ES, and just to make it simpler, so you're short, just give me one option. If you're short a put, in the 50 days at the 4,400 put. Okay. So I will go and look into, go to the trade page. And over on, you see where you have delta on the upper right hand, it is one of the column headings. If you click on that and you select implied volatility, down there towards the middle, and then open up those 50-day options. And if you go down to the 4,400 strike, what is the implied volatility of that put? 31%.
Okay.
So when I started doing this many, many years ago, one of the first things I did, this was before we had all the tools and programming and all that stuff, is I built skew models. Okay. And how does the skew shape? How is it shaped? How does it move over time? How does it move in response to changes in the stock price? Because I was a market maker and working in a market making firm, we needed that information. But what a good benchmark is to say, if the S&Ps drop 1,000 points down from 5496 down to 4,400, that's a big move down. Would the implied volatility of the at the monies be about 31%? Now, if it happens tomorrow, it's probably going to be, if it drops 1,000 points this afternoon, it's probably going to be higher than 31%. But if it drifts lower, if it goes down 50, down 100, down 50, down 75, over the course of 50 days, yeah, the VIX will probably go from 17 to 20 to 23, et cetera, et cetera. So depending on the timing, a stress test of saying that, well, the volatility might go from 17 up to another 14 or 15 points to about 32, that is a place to start the analysis. Okay, it gives you a Bobby, I don't know what the right answer is. I don't know what volatility is going to be if it goes down, if it drops 1,000 points. I don't know. Could be 30, 40, 50, 60. I don't know. But what I like to do is have a reason why I'm looking at the numbers I am. And as a place to start, I will look at that individual options implied volatility and say, if the at the money, in other words, the shape of the skew is, I guess, like a parabola. It has its bottom, its lowest point near the at the money, and it slopes upward. It's upward sloping as you move out of the money strikes. And so the way I think about it is that at the money will swim up that IV curve, that skew. Okay. So it'll go, the at the money 17, it'll go up to, it is as the ES keeps dropping, it will swim up to that 31% level. Now, maybe it'll go higher, maybe it'll be lower, I don't know. But that's where I would start the analysis. You can say, hey, TP, you're wrong. I've done my analysis, and it would, if the ES goes down to 4,400, it's going to be 41%. Okay. Put 41% in there. In other words, make that change, add 25%, it's 25 points to the VIX and stress test there. If you really want to stress it, what's the highest the VIX has ever been? 80, 90, something like that. Yeah. Stick that number in there. Okay. But what you want to do is have, so, and I'm not criticizing you for putting up 25. That's a good place to start too. But if you want to rationalize it a little bit, say, okay, here's why I put up 15 in there, because I was looking at the 4,400 put, it had a 31% IV, and I thought, okay, if the S&Ps drop down to that point at some point between now and expiration, the at the monies might look like 31%. Right. So that's the only thing I would change. But what you're doing is, as you said, stress testing the system. And if you wanted to get into fancy, value or risk stuff, you could build your own little platform and do all sorts of scenario testing. Personally, I don't think there's a whole lot of value in that. I think what you're doing, Bobby, is about as much as you need to do to get the information you need. Because here's the thing, I don't care whether volatility goes from 13 to 31 or 41 or whatever. There's going to be a huge loss, the theoretical loss. Are you okay losing $200,000? Maybe you are, maybe you're not. I can't answer that question. If you're not, maybe that position is too big. Maybe you need to put on a little bit more of a hedge, whatever. But what you're doing is stress testing the system and asking the question, am I okay with that potential loss? Is it going to be exactly that number? Of course not. Time passes, volatility will be some different number than, let's say, 41% or 31%. So your P&L is not going to be exactly down $200,000, but the bleeding will probably be pretty severe. So let me stop there for a second. Any questions or comments about what I just said.
No, I think that's good though, PP, because this is something I've never looked at the individual implied volatility of a certain option. And like you say, it gives us a great starting point. So I like that. I am interested. It seems like this is more, Tasty Trade is more of a visual platform, and it's interesting that this is more of a numeric type analysis rather than what you guys did in Thinkorswim, which basically showed, it showed the lines going up like this, and the
Mhm.
volatility lines and things of that nature. I was just curious as to why, not saying that one's right or the other, but why you guys went to more of a numbers type calculation rather than the visual.
So the reason you're seeing a different, it's the best way to think about it. Well, let me step back and say, um, I've known a lot of traders in my years, a lot of people who've tried to trade, and the people that seem to have longevity, in other words, they're still trading after 10, 20, 30 years, they never stop asking questions, and they're always looking to learn something new. Okay. So that is my worldview of traders. Okay. The worst, and I won't name names. You might know who they, but I won't name names, but it's the people that aren't around anymore are the ones that have a big winning trade when they first kind of start out and said, my God, I figured out how to make money, right? I've got the system, I know what to do. And they stick with that and they keep trying it until, well, it stops working, and they don't know how to adjust. They don't know how to improve their trading. So the same is kind of true on a little less severe scale in technology. We built Thinkorswim with what we knew when we started it in 2000. We knew what we knew in 2000, 2004, 2006, 2010. We built the platform with a lot of, so I came from the board of trade, trading bond options, moved over to an institutional technology, worked there for a year, and then hooked up with Tom Sosnoff back in 2000 to start Thinkorswim. We had that background. Tom was a market maker at the board of trade, or at the CBOE. So we had that background. That is a limited amount. It's very valuable information, but it's a limited amount. We learned a lot from our customers. We hadn't really worked with retail traders before. The questions that you guys asked, the tools that you demanded made us better, made us smarter. We learned a lot from you. The same is true when we started Tasty Trade back in, 2013, 2011 or whatever it was. We keep learning from you. Bobby, when you send in emails, when any of your participants send in emails and ask questions, like, hey, Tiva, why does this number work this way? I don't know. Let me think about that. It makes me smarter. Okay. And we try to give you the tools that we think we've learned about, that you have demanded, and that we think are an improvement on the old style. What this grid shows you is it's easier to control the numbers that you want to see on this platform than the old TOS. You can get the same results on the TOS analyze page, but that is 2004 technology or interface, not 2019, 2020 interface. Okay. So it's easier to make individual adjustments on this interface than it is the old analyze page. It's a busy, Bobby, you're looking at a busy page. There's a lot going on here. And one of the reasons is that you have a lot of positions concentrated in ES. So you have rows and rows and rows of stuff. It's easier to see that, I think, on this platform than it is on Thinkorswim. if you remember on the analyze page on Thinkorswim, you had that little box at the bottom and you had to drag it up and it would only drag up so far and you had to scroll through your position. It was okay. I mean, it worked. The numbers were accurate, but it was harder. This, I think, is easier, and it is for the type of trader for whom this information would be valuable, like you and everybody on this call, maybe. This is an easier, these just pure numbers are a little bit easier. Some people like graphics. Just like on the trade page, you can look at the curve or you can look at the table. I'm a table guy. The curve, I don't use the curve too much when I'm doing trades. Don't use it at all. I just look at the table. I know which options I want to sell or buy or whatever I'm typically selling. I zoom right into those, click, sell, boom, I'm done. Same thing here. You can look at the numbers, see what numbers are important to you, and proceed. You don't have to scroll your cursor along a graph. Say, what's that number again? Oh, if I move it this a little bit more down here, what does it show you? It shows you, down 4%, up 4%, up 12%. And this, by the way, Bobby, and this is the way Thinkorswim was built too. These are just the stress test for span margining. Okay. So when you're doing, or TIMS, I should say TIMS. When you're trading futures options, the margin calculations used to be called span, now it's called TIMS, created by the CME, and it just stress tests like what you're doing, Bobby. It stress tests your position. It says S&Ps move up a certain amount, down a certain amount, the volatility changes a certain amount. What's the maximum loss? What's the maximum theoretical loss of your position? That's the margin requirement. We had to build that into the platform. So we said, hey, why don't we just present this as a risk grid for our customers? So that's what this is. So anyway, I don't know if that answers the question or not. But what you see, Bobby, is along that top where IV goes up and down, up 1%, up 2%, or right along that top grid right there, or that top horizontal line right there. That's the index price. So that's index price down 12%. And then just above there, Bobby, that's volatility down 3%. So that's the way you interpret that, and you control those things with those arrows to your left. If you move all the way to the left, right around in there, and you start clicking on just right there, and you can see all what those things do. So that's a whole other level of control on this platform. And it lets you say slice and dice this position as much as you want. But before we run out of time, let me tell you what not to do with volatility.
Okay.
And this, I think, is, remember, we don't pay our bills with volatility. The electric company still demands dollars, right?
Yep.
As much as I argue with them, they still want dollars. So I need to make dollars, and dollars are what matter to me. If I go into, Bobby, can you go into the trade page again, please? And let's take a look at some really short-term options. Let's go down into, let's go into 1 days just to make it, just to have a social discussion here, and scroll all the way down to, I don't know, let's go down to the 4,400 put. See what that number is. There it is. Okay, perfect. So the implied volatility there is 120%. So does that mean that if the S&Ps dropped 1,000 points or 1,100 points today, that volatility would go up to 116%? Maybe. Yeah, I'm not saying it's wrong. But is that 116% number informative? Okay, I'm going to say it's not. The reason is that the implied volatility, go through, and if I'm repeating myself, if everybody knows this, stop me, Bobby. But that implied volatility is simply the volatility input into, let's say, Black-Scholes or an option pricing model that makes the market value, that makes the, excuse me, the theoretical value equal to the market value. That's all implied volatility is. What's the market value of that 4,400 put right now? Well, it's zero bid. There's no bid for it. It's at 5 cents. The option's basically worthless. But to the implied volatility calculation, it needs a number. The mark on that, and what do we say? Well, the theoretical price is the average of the bid and ask. That works in most cases. Here, it's 2.5 cents. It's zero. What's the average between 0 and 5 cents? 2.5 cents. The problem is the vega of these options is really, really small with 1 day to expiration, and vega decreases as we approach expiration. It's higher as you look further out in time. Okay, we know that. So with a very, very low vega, and as a trader, I know that 4,400 put is worthless. To give that 4,400 put a 2.5 cent theoretical value, I need to jack that implied volatility up to 120% to make it worth anything. Okay. So that's why sometimes doing what I just showed you, and I don't want to confuse everybody, but I want people to be aware as you get closer to expiration and you do those stress tests. You say, well, I'm trading these zero DT options. I want to stress test my position. What should I set my volatility to? I don't necessarily think 120% is realistic. Okay, simply because that implied I call it a phantom implied volatility. It's real, it's mathematically real, but it's not particularly informative. So I would go scroll down to something where, or scroll back up to higher strikes, to something where they actually have bids and offers around here, 70%, 68%, something like that. If the S&P's dropped 1,000 points, yeah, 70% on the VIX is probably a little bit more realistic than 120%. Now, this is an extreme case. 1 day to go. Is it going to drop 1,000 points? Maybe, probably not. What if I have a week to go? What if I have 15 days? What if I have the situation where it's, the close, roll, or hold at 21 days, right? What number do I use there? This is the balancing act, and this is something you build up as a trader. Okay, is which volatility do I want to use when I stress test my position? So let me stop there. Any questions, problems, anybody who has a different approach, I'd love to hear it. And I mean that because I steal everybody's ideas. If it can make me a nickel more, I'll steal the idea.
TP, one other thing. So we like this, and we like that we can uncheck things and we can see, like, here's my hedge. I can see I'm 261 with my hedge. If I take this hedge off, I'm 306. So I know what my hedge is doing. What is this span scenarios?
That is specifically, it is misnomered. It should be Tim's, because I'm all about copyright protection.
Sure.
It used to be called Span, now it's called Tim's. That is the actual, and let me restate that. When you were looking at the risk analysis, you don't have to go back to risk analysis. It had S&Ps goes up and down a certain amount, volatility changes a certain amount. it's the same code as span or TIMS, right? It's the
Okay.
same code. It's a stress test. That's all it is. It's just the risk analysis uses different slices, uses different data points up and down than span does. Span is a wider range. So as you see at the current price, is up 33%, down 33%, up 67%, down 67%. Right as you look along the top, volatility is up, down, up, down, up, down. I don't remember exactly how much the volatility is changing in span, but in span, it's 1 day. Span slash Tim's is 1 day. The CME only cares that you have enough money to cover the potential loss tomorrow. That's all they care about. They don't care about 50 days from now. They want the money tomorrow. So these numbers show you. So in other words, what you're seeing down there is 22,803. What does that mean? Well, if volatility goes up, and here it is, actually, it's over on the left-hand side. If you go all the way over there, it's volatility up and down 26%. Right down there. So if volatility goes up 26% and the market drops 67%, your loss on that position is $22,000 tomorrow. Okay, in 1 day. Loss is much greater if you extend it out 50 days, but tomorrow, that's how much you would lose. That's how much you'd lose.
Okay.
So it's the same. If anybody codes for a living, builds software, we just use the same calculations, the same grid that we needed for the span slash Tim's margin requirements and applied that just to the risk analysis.
Okay.
We are lazy. We try to use as much code as we can. And that's all it is. So is there a difference? No, the span number is very specific. It is calculate your margin requirement tomorrow. It's less flexible, right? Because the CME demands, you will tell us how much the max loss is up at these fixed points, down these number of fixed points, and volatility doing this. The risk analysis, we relax those requirements to give you more flexibility. That's all the difference is. But the numbers should, if you matched up the numbers between them, they should theoretically be the same.
So if we were trading all SPY, these would be blank? Would that be if we're trading something?
Not necessarily, and
Okay.
I don't, in the count I'm looking at, I don't have any SPY positions, but and I'd have to enter some SPY positions, but my guess is no, they would not be blank. Let me do this real quick here. I'm going to tell you, because let me open up an Amazon position. And I don't, I'm not gonna, I don't want to waste your guys' time with me clicking through my platform. Suffice it to say that it is not as useful. If you're trading SPY, you don't need this.
Okay.
So the
Gotcha.
risk analysis is more informative for almost anything. It just lets you drill down more. It gives you more control. The span scenarios and stuff is a margin requirement for futures.
Okay.
That's
Gotcha.
what it is. And yeah, I think it should be 0 if you're looking at SPY.
Okay. Well, I for one feel much better knowing that we kind of got the brains behind this to make sure that we're using it correctly. Anyone got any questions for TP at all?
Yeah, I do. Hey, this is Steve.
Hi, Steve.
I want to ask you a question. Does the mobile app have all the same functionality as the desktop app?
No, it does not. As far as I can tell. And here's the thing. I use the mobile app primarily when I wake up in the middle of the night. and just put it in a rollover. Oh, what are SPOOs doing? What are bonds doing? I use it mainly for quotes and to enter very simple trades. I don't use it for analysis. The problem is there's the geography of your iPhone screen just doesn't support this type of functionality unless you have Superman vision. Okay. So I'll say the short answer, Steve, is no. It has a lot of the functionality with if you want to check the volatility, if you want to, enter trades, see your capital requirements, things like that. It has a lot of the functionality, but it's not going to have, as far as I can tell, the analysis stuff. So what Bobby was doing, showing you all that giant grid of numbers, there's just not the space on a phone.
Right. I got you. One more question.
Yep.
I don't know, just a comment for the future. On iPhone, on the positions tab, there's no custom grouping and for your positions. And there's also, I can't seem to get my positions to sort by DTE or P&L or anything. It's just the standard sorting is by DTE, and I don't see any way to adjust it on my phone.
There is
I
custom
think that's-
grouping. I think Matt said there's custom grouping as well, but I believe there is custom grouping on the iPhone.
I'll have to look specifically in there. And this is not the question you're asking, but there are bugs. Okay. And we had a problem with some of our watch list functionality over the past couple of days. I'm not even going to tell you because I don't want to embarrass the programmers. But they fixed it, but there were some problems. So it may be, Steve, that you're not seeing it. I'll have to test that specifically on my iPhone. And yeah, for some people, the world is moving. I get it. I'm old. I sit in front of a computer screen. Other people are out there living their lives and doing all sorts of fun things. And yeah, you want to trade off your phones and stuff. I get it. And I don't think, Steve, that would be that grouping. That's something you should be able to do on your phone. In other words, that's not a real estate question.
Yeah. All right. Thank you, sir. I appreciate it.
You're welcome. Good luck trading, man.
Anyone else with a question?
Questions, comments, ugly recriminations?
Yeah,
I'm open to all of them.
Yeah, I have a question.
Yeah, Mike.
Hey, thanks TP for coming. My question is, how useful is on the main page, the PL, where you click the PL and it gives you the theoretical of all your positions, good, bad, or ugly. I don't know if Bobby, if you can go to yours and click one of the it looks like a slope of a mountain. What you're just showing a few minutes ago there. If you go back to the main
Here.
Yep, correct. Yep. How useful is that? And I mean, it gives you an eyeball, but I'm assuming it doesn't really include. Well, it includes some volatility, but I'll let you just kind of explain it.
So, Mike, there's some. So, the advantage of that, some people are genuinely, and this is not throwing shade on anybody. Some people interpret things visually better than others. They really, and I'm not, that's just the way our brains work, right?
Yeah.
So as you can see, there's a lot of opportunity. I don't know what the numbers are here, and I'd have to kind of, some people are okay, like Bobby's moving that cursor, and you look over on the right-hand side, in the upper right-hand, and you see the P&L, and okay, yeah, you're up $20,000 if it does that, and it moves around. That camel's hump in the middle is a visual representation of the normal distribution, showing you not numerically, but visually, the hump of the curve is the highest probability occurrence for the ES. As you move out towards the wings, as you move over to the left, yeah, where it gets really red and scary and the losses are big, the area under that normal curve is smaller. So the probability is relatively low. So, Mike, that's how you interpret it.
Yeah, all right. So,
I do not, and to answer your question, Mike, I don't use this.
Yeah.
It's I can look, and that's because I've done this for 100 years, and I can look at a position. I know what the loss is going to be. I know, I can look at an option, tell you what, okay, the probability is this, blah, 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 blah. Okay. But that's only because I've seen this hundreds of thousands of times. Some people like to see that visual. Okay, use it. Just like I say, Mike, I don't use charts. I don't look at fundamental analysis, but if you use them to determine your bullish or bearish bias, use them.
All right.
Okay. So it's, hey, look, I own a chunk of, well, it's now IG, right? I have equity. The more you guys trade, the more customers we have, the better it is for me personally in my equity in the company. So I don't want to say, oh, Mike, you're using charts. Charts don't work. I'm not going to tell you that. They may not work for me. I don't know everything. I'm not that smart. If they work for you, if you can actually make money using charts, use the charts.
All right.
The only thing I will ask you, Mike, is if you're looking at the earnings of a stock and think Tesla's going to rebound for whatever reason, use a high probability strategy. Don't just buy the stock. Don't buy an out of the money call, please. Sell a put if you have the capital, or sell a put spread if you want to be very capital efficient. And by the way, I'm trading a lot more verticals than I am individual options now, simply because the return on capital is much higher. So to answer your question, that analysis page, I don't use it a lot, but I'm not saying you shouldn't. Each of us has his or her own approach to trading. Hey, there's no best. There is no best. There's only what works for you and your risk tolerances and what you like to see.
All right. So just another tool. So yeah, got it. All right. Yeah,
That's exactly right.
All right. Thank you.
Yeah, and Mike, and that's fine. I don't want to belabor this point, but if you don't need it, you don't have to use it. We build things for tens of thousands, hundreds of thousands of customers. I don't use everything in my own trading.
Yeah. All right. Thank you.
All right, anyone else?
I have a question.
Schwartz.
There was.
Hey, I was trading with you guys before you sold. That's a long time. You talk about being old. That's a long time ago. And I loved your platform on Thinkorswim because it was very visual. And I'm a very visual person. So I loved the analyzer.
Mm-hmm.
Used it I still actually have a couple of accounts over there, which I'm probably going to switch over, but I would like to see the analyzer where you can actually see the current P&L.
Mm-hmm.
And also where you can save trades to like a text file and then import them back in. So you can, that was very, very helpful for me to be able to see my entire trade and all the different adjustments that I made to it.
Yeah, that's a fair point. That's a fair point. And I know, that was part of some of the original specs that we built. And if I don't know if anybody remembers here, the Tasty Trade platform used to be called Dough, DOUGH.
I remember that.
And that's because our business model, and we used to route the trades over to Thinkorswim and get paid that way. That fell apart. And so anyway, so some of the original specs for the analyze pages, Schwaz is pointing out, had some of that functionality in it. I'll stir the pot a little bit and see if we can get some of those tools added in. Just to let everybody know, this whole IG, great folks over there in England. But there's a lot of integration that's required, that's taking up a lot of development time. That's why sometimes the development work on the platform is a little bit slower these days. But don't worry, we're going to get back on the saddle.
I have one more thing too.
Yes, sir.
And I have a trading group that I trade with, and we like to share trades. So I know Thinkorswim had a place where you could copy the trade in a text format, and then then you can just paste that into like a Skype group or Discord or whatever. And I don't think I see that on Tasty Trade.
Well, can't you can take, let me do something real quick here. If and I am not, a big media person. So if I review and send, the only thing I think you can do is just, like Command Shift 4 or whatever it is, or whatever the
Like a screenshot or something.
little screenshot is. That's the only way I think you can do it. I don't believe you can. I don't think it lets you save it.
Yeah.
I'm looking through that because I clicked, I'm just selling to put in Amazon. And I don't see that functionality.
It has a button to say, copy trade. And then it puts the copy on your computer or desktop.
Yeah.
And then you can just paste it over there without having to deal with it. So just another idea.
Thank you, Schwaz. Thank you.
Stefan wants to know, TP, if you do any kind of black swan hedging at all.
Do I do any kind of black swan hedging?
Yes.
Well, yeah. I mean, I'm perpetually along the VIX, which hasn't worked out at all over the past number of years. And I have been selling more. I've been doing more defined risk trades. So I don't. Here's the problem with black swan hedges. That you can bet on a black swan. To me, hedge is a 4-letter word. Okay. It's foul language. Why are you hedging in the first place? What are you hedging? If you came to me and said, Tom, I worked at Boeing for many years and I have some stock, or Apple or something, and my cost basis is so low that I don't want to incur the tax consequence of closing the position. Okay, fine, I get it. Let's talk about a hedge for your Apple or your Boeing or something like that. But if Bobby's asking me, hey, I'm worried about my ES position, I'm gonna ask Bobby, what do you have it on for? If you're thinking about a hedge, if you're scared of the black swan event, why do you have that naked short put if you are actually scared of it? Right? I'd say take it off. But the proof of the pudding is in the taste, right? Bobby has that short put on. I have that short put spread on because I'm not that scared of the black swan. I think it's possible. I don't think it's likely. So the black swan hedge for me is simply buying that out of the money. I'm selling a put, but I'm buying that out of the money put, mainly not as a hedge, but as a capital reduction strategy. So hedge, I hear you. I get where you're coming from. But I don't like to think about hedging positions sort of like my own stuff. I don't think of it as a hedge. And if I am thinking about a black swan move, if I'm going to take advantage of that, I don't think so much of it as a hedge as it is, hey, I think the market might crash at some point. I'm leaning on the VIX. I'm getting long the VIX. And like I said, that's been a losing trade for me for a while. Okay. Hey, I have lots of losing trades. And I would change the thinking slightly on that. The way you quote unquote hedge potential losers, or the way you cover potential losing trades, is by making future winning trades. So Bobby's coming in here and he's got all his stuff in ES. and maybe he's got some massive loss in ES. How do I, my natural inclination is, hey, I want to make it back in ES. That's not the way to think about it. Your money doesn't care where it comes from. That the money I can make in Amazon or Tesla or IBM is the same money I make in ES or NASDAQ or VIX. Money doesn't care. So I'm going to look for trading opportunities. I got burned by ES. Ouch. Market crashed. I had that short put, couldn't cover it. Ouch. How do I make it back? If I see opportunity in ES, I will trade ES. But if I see more opportunity in other products, I will look at those other products. Be product indifferent. So the black swan event, is that going to happen in ES? That's what everybody think, NASDAQ. Yeah, we think about it in terms of indexes, but maybe not in individual stocks. Maybe there's opportunities in individual stocks. Maybe, I'll hedge my short put in ES with a bearish position in NVIDIA. Okay. Or a long position in gold. I don't know if there's a relationship between the S&Ps and gold anymore, but maybe that's how I do it. So that's how I want people to start thinking a little bit, is what other opportunities are out there that can make me some money, that if the market does crash and kill my short put in the ES, that I recoup some of the loss. Doesn't have to be in ES.
Okay, maybe time for one more question for TP before we let him go. We've been very cautious of his time and very appreciative of his time, but anyone else got one more question we could shoot for TP? John brought up diversification instead of hedging, and I think there's something to be said to that.
Yes. So what John, and this is the whole Liz and Jenny approach, trade small, trade often. That as if we treat assets, and I do, and you don't have to, and this is my worldview, that the ES and the VIX and bonds and Amazon and Tesla are all standard normal variables. Okay, they're all standard normal variables. I can't predict which way they're going to go, and they accumulate. They don't always follow that normal curve, but if I look at 10 of them, 50 of them, 100 of them, 1,000 of them over 10,000, 20,000 trades, just like the central limit theorem predicts, those results tend to stick to that normal distribution curve. So to John's point, diversification, not just through products, not just through Amazon and NVIDIA and Netflix and ES and VIX, but over expirations, across volatility, across strategy. That's what saves you in those black swan events.
Good. Don't let TP go. Market's moving up again. You're making the market move up. We're going to hold on.
Oh, geez. All right. I got to quit then. No, I don't know. I was doing pretty well this morning.
Oh, man. Hey, listen, TP, thanks for coming on today and sharing your wisdom. And we appreciate all that you guys do. It's a great platform. We appreciate the work that's gone into it, and it makes our lives a lot simpler. When I did my corporate account, the attorney and the accountant that I was working for said, I guess you'll be using Interactive Brokers like everyone else. And I said, oh, hell no, I won't be using Interactive Brokers. And I brought up Tasty Trade, and they said, never heard of it. And I said, well, you need to hear of it. I said, because I've been around folks that have used Interactive Brokers. And I said, Tasty is, puts that brokerage to shame.
Well, Bobby, thank you very much for your ambassadorship. I appreciate that. And by the way, if anybody's curious, all those tools that IB Interactive Brokers has now, they stole from Thinkorswim. So whatever, I get it. I get it. But they're a few steps behind us, just like Fidelity is. It's whatever. So if you want the best stuff, I think come play in our sandbox. If anybody has any other questions, suggestions, or anything, email me at try TP@tastylive.com. Just the initials TP, Tom Preston, TP@tastylive.com. If that doesn't seem to work, try Thomas.Preston@tastylive.com. We've got through a few email migrations. Let me just go into let me just check something real quick here.
I think I sent it at TP@tastylive.com.
Let me just check real quick contact. TP@tastylive. Yeah, that should work. That should work. So if you have any questions or suggestions or anything like that, or you know, if Bobby, you want to stump me with anything, that's how you reach me.
Well, we appreciate it, TP. We'll let you get back to the cows. I got to get back to the goats and the ducks and the chickens and the pigs.
I like it. All right, folks. Thanks for joining us today. Bobby, thanks for setting all this up, and good luck trading, folks.
Thanks, TP. Thanks, everybody. Bye-bye.